I think this is my first chance to step into Sankalpo's shoes and introduce everybody. So to the guests, apologies in advance. To my audience, enjoy this because this is the first time I'm doing it. So good evening, ladies and gentlemen. On behalf of the team here, I welcome you to this session today with Mr. Nitin Rao. So Nitin Rao's introduction is quite long, and I was wondering whether it will take up a lot more time in terms of the show. But I will just introduce Nitin in my own personal way. He's the CEO of Incred Wealth, and I will introduce him as a person as we go along. But professionally, the way I know him, he's had a glittering career with marquee organizations, launching differentiated products, launching businesses, building businesses, scaling up businesses, and being part of various industry committees, which have just added to his career. Kashyap is my colleague. He joins us today, and he's the co-host along with me. Kashyap is a fund manager at Emkay Investment Managers, and Sankalpo is from PMS AIF World, and Sankalpo is responsible for me making this introduction to you right now. Thanks to PMS AIF World and thanks to Finland Academy for this, for this opportunity. So I'll just deep dive in, Nitin, with your permission. Can I just go straight to the personal aspect of it, introducing you again?
No problem.
Yeah. For those of you who know Nitin and who've been following his career, I think he needs no introduction. I've been one of the people who's worked with him, as an industry participant. Like I was telling the guests earlier that, we fought in the trenches and we've got a lot of wartime stories. But at a personal level, what I've really liked about Nitin throughout the last 25 years that I know him is I have the utmost regard for him, not just as a professional, but as a thorough gentleman in his personal capacity. I mean, the manifestation of it is right now when I'm just cutting short the introduction and he still has a big smile on his face, as a thorough gentleman. Nitin, your colleagues tell me that your grip on numbers is amazing. In fact, three of them have at least told me that it is intimidating because apparently you have numbers at the fingertips, and even before somebody, one of them said that once he sent you the numbers a little late in the morning for a 9:30 meeting, he sent it to you at 9, thinking that you might not have enough time to look through it. But not only did you look through it, you found errors in the numbers, you also found some flaws also in terms of the process, which is completely awesome and completely intimidating for your colleagues. This is something which I will vouch for, and I think Sankalpo did mention to it, allude to it earlier. Strategy is your forte, and you have a unique ability of not just de-risking. I mean, when you think of a plan B, when there's a strategy, when there's a plan B, you don't just think of de-risking, but also planning alternate options and pulling the plug all at the same time. You have a plan B ready, which makes it very easy to analyze and balance out what decisions need to be taken. Your career has amplified one very big aspect of yours, which is a very high client focus, and that is also to do with you as a person. You have a very high EQ or empathy quotient, and your colleagues vouch for that. You understand them. In fact, the adjective I've got is we adore him for that. You're very structured. You have a no-nonsense approach to life, and I think one of your biggest qualities is you're extremely punctual. I've experienced that in the interaction we've just had today. You're always 2 or 3 minutes before schedule. But quite contrary to that, Nitin, is your dry, deadpan sense of humor. You have a very dry sense of humor, which at times just sneaks in, and most of the time it catches your colleagues unaware. They don't know whether you're joking or actually you're making a point, which is actually something which is even more amazing. You're usually a very composed person, but like any other Mumbai traffic gets to you. Over the years, I've seen you evolve as a person, and I think one very big catalyst in that is, your affiliation to the Isha Foundation. You're very committed to that, and you believe in meditation and holistic healing. You prefer simple and nutritious food. At a family level, your wife Radhika is a practicing homeopath doctor, and you have 2 children. Elder one, Anirudh, is in the US, and the younger one, Anushka, has just got into grade 12. I believe Anushka is quite creative and she takes after you from that point of view, because one of the interesting things I came to know is that you are a marketing major from Symbiosis Institute of Management. I thought that I was the only one, but it turns out that there are 2 of us right now. We are 2 marketing majors heading financial services organizations. Apparently, you're a very creative person, and what hooked you onto the capital markets is after you won a stock market gain in one of your college festivals. Just for the audience, while we were talking, we realized that when Nitin was in Symbiosis, I was also probably at one of those festivals. Not that we met then, but that just draws us back. Nitin, there's a very unusual combination you have as part of your student career. You were president of the Students' Council in your college and Gentleman Student of the Year. I really can't think of these two together. Very, very rare combination, if one may add. You've played football in college. You prefer the Brazilian style of football to European. And I don't think anybody will be surprised in that. But you're also a very avid cricketing follower. You're a very avid cricket follower. So if I ask you who's going to win the T20 World Cup, I already know the answer. So thank you so much, Nitin. Thank you so much, everybody, for the show today, for being on the show today. So I'll just deep dive straight into the questions. Nitin, my first question to you is, keeping in mind the topic. By the way, quite a few questions have come in from Twitter, they have come in on mail. So there seems to be a fair amount of interest. So please feel free to amplify any point which you have. We will also keep asking you to substantiate with examples wherever we think it is required. So Nitin, the first question is, in the arena of wealth management, is there a difference you find between the right solution and the right product?
See, firstly, because thanks, I think your introduction does extraordinary justice, much beyond what I deserve. So really thanks for that. Thanks for everyone for hosting us on this. Topic is complicated and hopefully we will throw some light on this. On the question, firstly, I do want to throw a little bit of light into the way I have seen wealth management evolve before I delve into this area. So I still remember when I started wealth in HDFC Bank, we started it with two people, and we started it in direct equities because by nature, after doing my marketing, I became an equity research analyst, tracking sectors and stocks. So I was on the prop book of HDFC doing research, and there were events which led to me starting advising clients on direct equities, where the top guys there said, whatever you do, don't touch the bank clients, because if you lose money, they will run away. Right? So that was the origin of wealth management, maybe in domestic banks.
Interesting.
And then we gradually started with equities. Then there was a period when reforms happened and the mutual fund industry began. I don't think retail investors or even too many people were in mutual funds. So we saw that phase of evolution of mutual funds. Then that became a phase wherein they said everybody wants it now. So we want it to be sold to bank customers because we are doing well. People are liking the thoughts. And that's when the industry started evolving. Then one of the competitors opened up the AIF space some 5-6 years back. We saw evolution there. And so the industry has evolved through different frameworks, through different cycles. Also must kind of highlight that in the first kind of 10 years, the markets were in a 3,000 to 7,000 range on the Sensex. And you actually saw it fluctuate 4-5 times from 3,000 to 7,000, back to 3,000, back to 7,000. So you really didn't know what was happening. And then it has gradually gone to 12,000, then 16,000. Then when Modi won, it just has rallied, and that rally continues. So first and foremost, have been a believer in long-term. Long-term always wins. So strategies and all that should be thought in that framework. And coming down to the question that you asked on whether solution or product. See, I think it really depends upon how well your investor has evolved. Okay, because like you rightly said, empathizing is very, very important in our business. Even if you're in the stock market, it is a game between buyers and sellers. So you have to empathize why somebody is buying, you have to empathize why somebody is selling. Same way, when you are advising an investor, you have to empathize why that investor is buying or selling, or why he wants whatever product you want to offer. So what we have seen is that the scale of evolution of investors is vastly different from investor to investor. So
Okay.
over time, there would be investors who have really had full portfolios built with proper asset allocations across debt, across equity, with various products, and they've reached a certain level of optimization in their scale of business. That is where I think solutions fit in. So, kind of example is, if your need is retirement and the solution is a asset allocation which meets that need with life insurance cover, etc. But if you are a businessman who's already into a mix of good equities and all that, your return may be to beat the returns of your business. Then the products, then your solution will be different. If your taxation is high, then your solution is around tax related orientation of portfolios. If your need is, today there is a trend that globally there are different jurisdictions, there are different taxations, and so migration into, by investing into taxation, is a big thing globally. And people often say that Dubai is one of the places where a lot of family offices migrate because the tax regime is very low and very friendly. Or inheritance planning. I recently attended a session where there were many rich people of Bombay and Singapore and all that, where the discussion was how to transmit the wealth onward. So solutions come in there. Whereas, so that's the right solution, advisory, portfolio, whatever. But products are those where if you meet an investor and he has reached a certain, so by and large, if you see the Indian informed investor, he will be already into, because of the current generation of evolution, maybe mutual funds. And if you think that there are ways to better the return for the investor, then you can offer him products which enhance the returns. And then he will start testing those products and start integrating it into a portfolio. So then those products come in to enhance returns. So if somebody is a mutual fund investor, you may offer him products in the PMS AI space to kind of enhance returns a little bit. Or if he is already into the conventional products and he's not into, I keep making this example because today it's a very big mutual fund world, that the rich guys in India didn't become rich by investing in mutual funds. They became rich because they owned stock of the companies they worked in. So Infosys promoter had Infosys shares.
Yeah.
So then you evolve them into direct equities in line with the risk profile, of course. AIFs, PMSs gives opportunities into business. So products help enhance returns and are used to help customers get options which can come into their portfolio. And once their portfolios look good in some shape, then the solutions start coming in. So it's depending upon the need, lives. So they are all correlated. But as a person develops in his evolution, he requires more and more solutions. Otherwise, he tests products to kind of get into the crux of things.
It's interesting. In fact, I think you may have just given birth to a new acronym. There's an FII, there's a DII, now there's an III, Indian Informed Investor.
Yeah, true.
Yeah. Talking about that, you talked about the right solution and you talked about evolution of an investor. So let's talk about the evolution of III here. Typically, it is believed that the Ultra HNI segment is the most savvy segment. Okay. HNI or Ultra HNI segment is the most savvy segment. So A, your thoughts on that? Is it savviness across the board, or do you see an evolution happening there as well? And B, if there is an evolution happening there, how does a wealth manager, or how should a wealth manager suggest products to the investors? Is there a process to be followed here as well?
Okay, little complicated, but yes, the evolution of the investor is the most in the Ultra HNI segment.
Correct.
Because they have done it, they have seen it all, and they have a framework which is to maximize returns, which is built into their thoughts, and the surpluses are large. So the solutions are literally business kind of substitutes on whatever they're doing, and then protecting or growing wealth comes in. The HNI evolution is happening fast, but a lot of space to still go. Also, I believe that the ability to define risk and then to choose products is the highest in the ultra HNI investor,
Okay.
because the surpluses would be so defined that they can allocate in different categories. HNI investor right now is a step behind. And the other investors, if you ask me, in the last 6-8 months or 1 year or 2 years, have seen big shifts in their ability to understand, for example, stocks. I mean, linked to demonetization, linked to real estate going down as a favored asset class. There has been a strong evolution even in the Indian investor. So to that extent, there is clear evolutions happening in each of these segments, and they're really interesting for every wealth manager. So much so that we keep discussing, but we believe that the next 10 years is a big runway for growth for the wealth management industry in India. There are enough reports which have said that we are following China with a 10-year lag, which will see the creation of dollar millionaires and billionaires in big ways through IPOs and all that. So clearly that evolution is happening. Now, if you ask me, how should investors choose products?
No, my question is how should wealth managers as a process recommend products?
Okay.
That is something I think you had given me an insight on in one of our earlier
So
discussions.
I would like to share my screen there if you don't mind.
Sure.
Just so that, because it's complicated to explain straight, it is our framework, but I think it is
Sure.
it's a fair idea to give examples to people.
Sure.
So let me just share the screen. Just excuse me for a minute.
No, in the meantime, Sankalpo, I think you have run some polls. Would you like to talk about that?
Can you see the screen, Vikas?
Yeah, we can see the screen. I think he's got it there. He's got it.
And it's full size?
No, you'll have to put the view and then full screen mode, Control L. Yep, perfect.
Yeah.
Yep, now we can see it. Absolutely.
Okay. This is quite a good framework that some of my experienced colleagues have developed, and I think it fits the broader need. So it is all known that in the first, typically clients fall in profiles, right? And the first step is always to ensure that the profile of the client is well defined, either through questionnaires or through discussions on all that. Typically, we would believe that there are 4 or 5 client profiles. One is to very conservative, risk averse, preserves capital, is uncomfortable with investment losses. Stable means they would like to take marginal risk. Balanced is maintaining a balance between capital growth and security. Growth is chooses increased return potential over short-term safety, comfortable with higher volatility. And aggressive means ready to take substantial risk to improve return, may lose significant value. So often this is forgotten. Finally, risk is very critical in all this. Today you've seen examples of many startup founders risking their everything, running their businesses, and then minting returns in the long term, but they took risk in their businesses. And so to that extent, that is an emerging trend which is coming up in India. Now, after you look at this, you get a lot of products. And typically, I think risk has to be defined, where we would like to give product risk scores. Others could choose to have low risk, medium risk, high risk kind of things. So we would call a product like a bank account, liquid funds, overnight funds as low risk, which we give a product score of 1. As you go down the curve and you go to bonds with AAA or equivalent greater than 5 years, debt funds with 10 to 25% in AA, or AIFs which are in the long short range, we would call that a risk score of 4. As you go to mutual funds in the mid cap, small cap, sectoral thematic space, we would call them 6. Or if you go into bonds with A minus, BBB maturity, we would call that as the risk score of 6. And if you go to small cap, venture funds, etc., we would call that as the risk score of 8. So, first there is a risk profile: conservative, stable, balanced, growth, aggressive, and then you bracket products into a risk score, and then you decide which is suitable for your client. So, if you are conservative, you do not go beyond 4. It means you avoid everything which carries bonds at AA, equity oriented, mid cap, large cap. However, if you're a balanced profile, you can go up to 7, which is mid cap stocks. And if you're growth or aggressive, you can go up to things like private equity and all that. So that is the thought process under which one would look at uh, kind of putting a risk discussion there. And just to kind of highlight how this is done, and I'm using a product which is quite in fashion, forget the name, it is our own Incred MLD, which is a product which protects capital with a A-rated instrument below and gives you upside, giving a return of XIRR of 9.25%, and there are some tax advantages. If you see it, you see a 4 up there. So we would categorize that product as risk categorization of 4, which means customers who are up to that profile, balance profile, etc., can easily put in it. Now, if you see mutual funds, and these are large cap funds, we would call them a risk category of 5. If you see some AIFs, so so broadly, that is what I would like. So every product that we would look to offer would carry a number, a profile, and then you kind of correlate it. Once you reach there, and once you meet your customer and you understand what is suitable for him, then you can offer various products in that gamut. I think if RMs follow this, bracket customers into profiles and then offer products, one level of customer guidance and matching of products is taken care of.
Interesting. Very interesting. So you might technically have in the same...
Just 1 second before you come in, let me just put it to the audience. All the products shown here for our educational purposes. Please do not take them as advice. Do consult your investment advisor before taking any investing decision. These are all to make a point and for more educational purposes. Thank you, Vikas. Over to you.
Yeah, no problem. So if this is interesting. So if there are 3 ultra HNI investors and all 3 of them have different risk profiles, chances are that what we are talking to them in terms of products, they might either differ in recommendation or differ in weightages. Have I summed it up right?
Yeah, that is right. So if there is an ultra HNI investor who wants to, because the markets are doing well, and let's imagine that he has sold off stake in his company and he wants to diversify in equivalent businesses, which will give him growth over for his children over the long term. And we did it about 6-8 months back. We marketed a fund which was a consumer tech fund. You do know that a lot of companies today believe that the next generation of Indian investors is around the consumer tech boom, and with tech coming in. So if you market a consumer tech product, that ultra HNI investor got exposure to emerging consumer tech things like, say, Ayurvedic products or pet products or taxi sharing or something like that, and then evolves it over time. And this would be 6-7 year horizons. And tomorrow it could become a business alternative to what they are investing. Of course, it falls in the product category of 8 and hence is high risk. But if it gives returns, it gives returns. And so this product later saw the companies being sold to Marico, and then ITC taking a stake in that business to kind of help grow the consumer businesses. So I'm just giving an example, like someone rightly, and that product is closed now, so it's not that it's open. So I'm just giving an example of how a good product can fit the need. Sometime back, for again ultra HNI investors, there was an opportunity to invest in an international neobank. It is the new trend of digital banks which are coming up. And this was not in India, this was in UK. So there were customers who had money abroad who thought that this was a good option for them to invest. That is one segment of investors. There is another segment of UHNI investors who may have invested a lot into mutual funds because that's how they've evolved and all such things.
Correct.
And as you now know that a lot of the talent which was there in the mutual fund industry, the experienced guys, have moved on to AIFs and PMSs because by nature a mutual fund constrains a fund manager. They try to track the benchmark, and whereas a PMS gives more flexibility in terms of more risk, more exposure to a company and sectors, and to that extent, more alpha can be created. So one has seen a trend wherein a lot of products have come up in the PMS and the AIF space, and one has seen a trend where a lot of the UHNIs and now HNIs are looking for greater alpha in those products. Similarly, in debt, I can't not talk about debt because in debt, the last 2 years I've seen returns fall to literally 4.5% or 5% in the stable AAA kind of products. And risk as a concept has now started getting embraced in India on the debt side, which was not so aggressively being used. So just as today PMSs, AIFs and all can target 5 to 6% alpha long term, even in debt today, by going down the risk spectrum and logically allocating in portfolios, today you can get 8 to 9 to 10% returns with exposure to AA, BBB, A paper in suitable structures, which is a big change, which UHNIs have been doing it big time. And hence they become richer, obviously, because wealth creates wealth. Whereas I think the HNIs are also catching the bandwagon. Of course, Indian retail has not reached that space. They are innovating in the direct equity space right now. So that's how the evolution is happening.
Interesting. Kashyap, I think you also have a few questions. Would you like to go ahead?
Sure, Vikas. Thank you so much. First of all, Nitin, for gracing our show, and thank you, Vikas, for that kind introduction that you gave about me. This was my first chance to talk, so let me first thank both of you at the outset. So Nitin, my question is that in that chart that you showed about the product ranking in terms of risk, in terms of product innovation for investors. If you look at globally, a portfolio which was made up of only equities and bonds probably about, probably 20, 30 years ago. Now we are seeing, more of exotics, which are cross currency, or structured bonds. We see private equities. On the totally flip side, we also see a lot of passive investments over there. So for India, in terms of product innovation for investors, do you think the products that are available or innovated are now at par with global standards, or there is still a lot to be done in that particular field?
See, I think today, again, of course, upfront the answer is we are still lagging global standards. Okay, and that is more because to kind of just give you some background, like I told you, maybe 10, 12 years back, people would not even invest in mutual funds. Okay, and it took 10 years for the market to see a substantial portion of money coming into mutual funds. Okay, even if you see PMSs and AIFs, and you look back to see how many have 5-year track records, I don't think you'll find too many. And if you go back for a 10-year track record, I think you'll find 1 or 2. Right? So even the PMS and AIF industry, I think, is still in the 3 to 5 year kind of evolution phase. Right? There have been phases of product evolutions in the past, but because we are an emerging market, we have not really seen the runaway return that a product evolution should take. Okay, just to kind of explain, about 7 years back, we had met fund managers coming in from the US, and I had asked them that if you want return from PE funds, etc., vis-a-vis conventional return, why is PE fund so popular in the US? And then they said there the risk to return kind of equation plays out very well. And in the same period, if an equity fund gives you 4x, there it is quite common to see 9x, 10x kind of returns from PE funds, venture funds, etc. Which in India we have not seen for a long period of time. It's only this current bull run where you are seeing the internet companies and the startups now getting listed, that investors are able to exit at those 9x, 10x kind of returns, right? So I think we have reached a stage where the people who start, so there was a false alarm where people tried it out in the UHNI space, returns didn't come, and then it stagnated for some time, and PMS's AIFs evolved, right? Now I think the PE investors will see their returns, and I think the next generation of investors will now come in, and you will see a whole generation of wealth getting created through the venture route and all such things. So I think we lag the West on the equity side, and we have reached a certain stage where the initial investors are going to make good money, and now the next generation of investors with a 6-7 year kind of time horizon will come in. And if you see the products that different wealth managers now get, carry a flavor into emerging techs, emerging ideas, emerging thoughts, which is at an investment horizon of investment of 1 crore or so with a long-term time frame. So like I gave you an example of Neobank, or I gave you an example of consumer tech. You've seen unlisted securities market carry on like wildfire. NSE shares were there, pre-IPO funds have come up. So that sector, I mean, and I should congratulate some of our peers who went into this some 6-7 years back and will possibly now reap the benefits. But yes, that sector is evolving and will really create wealth in the future. And HNIs are trying that out, right? So we lag the West. More structures will come in the future, etc. Now on the debt side also, debt has evolved much slower than equity. And the last 1 year has seen a lot of evolution on debt, be it mainly because the returns on the conventional products have gone down and people have taken risk, and there's a whole new generation of thinkers. I keep saying that, like Vikas said, we have 20-25 years of experience, but I think the new millennials are emerging in the investment horizon, and I'm now a millennial, and I'm sure Vikas is also a millennial. So you are seeing debt investments of startups where they are well funded for say a 5-year horizon. They have big investors backing them, and they have things like working capital requirements, or they may be A-rated companies with strong promoters, with strong backings, and they are now coming into the market, raising debts in structures of 10%, putting them into market-linked debenture structures, and then marketing it. And you could either have it directly, like one I told you was Incred, and like it was rightly said that I'm not doing that to market a product, but various entities also have those products. Lending Card has it, Spandana has MLDs. That gets clubbed into AIF version in a combination of MLDs. Or now for the UHNI, something called venture debt is emerging, which is a combination of working capital debt plus warrants, giving 13-14% kind of IRR goals pre-tax. So that segment is emerging, and at this point of time, if you ask me, venture debt, which is very popular globally, is now coming into exposures into India. Also, people taking money abroad for dollar exposures in debt is coming out. Some evolution is also happening in the mutual fund space, where fund of funds for international exposure is coming in. So yes, we lag the international world. Regulations restrict it partially, but a whole lot of wealth managers who are coming up are breaking out of commoditized wealth products and introducing newer and newer innovations in the industry. And parallelly, today the industry has a lot of wealth managers with global experience.
Yeah, that is true.
This global experience even gets in these ideas into India, also builds up the risk-taking capabilities. and hence the evolution happens in innovation. So I think the way forward is innovation with the wealth management companies, and that's where the returns play out.
Right. So, picking up from there itself, so when you look at a wealth advisor, as an investor, then how should I evaluate him? Is it his ability to showcase, a wider suite of products that he can do for me? Should I evaluate him on, probably returns, or maybe risk-adjusted returns if that, sophistication is available to me? Or should I evaluate the advice based on, you also highlighted some of the objectives in the beginning, in terms of my risk appetite and the product range available. How would I then evaluate my wealth advisor, and how frequently should that be done?
In fact, if I can just add to Kashyap's question, one of the things which I face as an HNI investor is there is so much of information which comes to me from all sources. The advice which is given to me by my RM at times seems very, very adequate. At times seems inadequate because I'm getting information thrown at me from all sources, and it just kind of confuses me at times. So, how does Kashyap, if I've summarized the question correct, how do I actually evaluate whether my RM is actually giving me the right advice? Right being a little bit of an amorphous word, but assuming that it is in my best interest, how do I evaluate him and how often do I evaluate him?
See, it's a very complicated question, and I mean, some of the RMs may even say, "What am I saying?" But I mean, from time immemorial, I have believed that if I make on my debt 6 cents or 7% at that time when there were FDs, etc., and I'm a conventional investor, if I make 7% without an RM, that RM should be sorry. Before that, I would like to say because you used the word empathize sometime back.
Yes.
Okay, I think the best RM is one who can empathize with you and think like you on the wealth. Okay, and for that, he has to recognize the fact that as a customer, you have made the wealth because you are very knowledgeable, right?
Correct.
And you understand money and you understand business, and because of that, you took your risks and made wealth, right? Now, as a RM, I have to be at least equal to my customer in my thinking.
Absolutely.
Right? And for that, how do I become as knowledgeable as my customer, who, if he's a UHNW customer, has more than 100, 200 crores of wealth? If he is a HNI customer, has more than 15 crores of wealth, which he has earned in the hard way, right? So that, I believe, is by knowledge build-up, reading, understanding products, understanding risk, like I told you, knowing fund managers inside out, taking their views, and reaching the level of the RM. That's the first thing. So if I want somebody to manage my wealth, and in my case, I would be more of an informed investor, my RM has to be able to talk to me at my thought process.
Yes.
Okay. Now, after that, I keep telling this to people because many of the investors know everything. Aisa nahi hai ki they don't know. So then I typically tell investors that how much should you have made without me. So if I put money in FDs, I put money in direct mutual funds, in debt, or in first let's talk on debt, I would make 7-8%. Then what is the alpha that my wealth manager can give me either through products or through solutions, which will give me an alpha which justifies the cost or commission that the guy will earn.
Yes.
Okay. So if he's earning a commission, and I don't believe commission is a bad word. So if he earns 0.5% or 0.7 on debt, am I getting 2% alpha on debt? Of course, there is a risk profile and there is a mix of portfolio. That if you get that, he's a good wealth advisor. And moment you get into this discussion, you'll know whether the guy understands what he's saying or not. Risk is standard. I think a guy understands what is risk because he's made money the hard way. Nobody's made money in the easy way. Same goes for equity. If I was to invest in a passive equity fund, or if I was to invest in typical mutual funds, without a sector distribution, I would have made 12-13% return. You have to ignore the bull run at this point of time. And I would have made 12-13% return. Will I be able to give 5-6% alpha with the mix that I am giving of products? And hence, will the solutions have suitable products which give that alpha? And then it comes to so I can't form, you have to be figuring out whether you're a distributor or advisor. If you're a distributor, you have to see whether the products fit that framework. You can't advise, but you have to think like the customer and the investor and see whether those products fit the need.
Correct.
And if you're advisor, it's a consolidated basket. If I'm already making 7-8% and you want to charge 1%, I would expect that you'll give me 3-4% additional return.
Yep. Yep.
So I think if one gets that framework right, it puts pressure on the RM for sure. Right? But I mean, anybody who chooses to be in the wealth line chooses to build on it through knowledge. And then there are various other things which come in: leverage, borrowing of money to enhance returns. That the scale is innumerable. So it is really whether you can click with the customer, empathize with him, convince him that you have your thoughts, ideas, get the trust. And then obviously it will take time for the customer to build the relationship with you.
In fact, Sankalpa, I think you're running some polls. Would you like to talk about those polls, or should I move to the next question?
Discuss a couple of polls. Actually, I've asked 3 polls and I've not got a chance to discuss. So after this, there'll be some fresh polls. So, the first question that I asked was at Nifty 18,000, what do investors feel? Okay, 35,000, at 35% feel that they would want to buy more. So that's just how bullish we are. And in terms of...
Can you repeat that again? I'm just joking. Please go ahead.
So the next question, that the current poll that was running was, what do I seek from my wealth manager? Like we were discussing, knowledge and availability of products, get around 30%. Understanding the needs of an investor gets 70%. Providing executional support gets 0% votes. So, that's the general idea that investors have. There was another poll that I had clicked a photo of the result. I'll just tell you. So the second question was, I am content with the financial products available now. So, the maybe and the no basket together comprise around 53%. Okay. And only 15% say they are. So, we welcome you at PMS World to the world of new products. But, that's how the market is right now. So these are some insights from the audience.
I just want to add, I think the replies are very, very sensible. Because if you are a wealth manager, your constant need has to be to maximize return in the respective asset categories for your investor, and you have to constantly keep looking for something new. So to that extent, being content is perfect, not being content. Second, execution being 0 also, I'm very impressed. Because finally, customer is more bothered on whether he's got alpha, whether he's got more return. And for that, even if execution is a little bit of a challenge, it's fine. Because finally, return is more important than execution. That is my...
I completely
business we would like to build easy execution and smooth transition and all that. But finally, you're in this game for increasing returns for money, right?
In fact, Nitin, if I can just put another thing, as an investor, for me, execution is a given. If it is difficult, it is difficult. If it is easy, it is easy. It is not going to be different for me. What has to be different for me is the return I make. So I think perfect. This is a good point. In fact, I wanted to ask you the next question, but you've already answered my next question, in which I was talking to you about the fact that considering all financial services firms are becoming more tech-driven, is it eating into the human interaction part of it? I think you've already answered that in a very...
No, I want to...
You want to answer some more?
Please. Answer it a little differently. See, when you look at tech, there are 2-3 things. One is platform. Okay, whether you have a good mutual fund platform, whether you have a good equities platform. Now, in that space, today we are on the core portfolios of the investors. We have very good platforms, right? So really, there is no problem of technology there. And a lot of evolution can happen on execution. On products like PMS, AIF, international products, there is some space for technological evolution to happen. So I would say individual asset categories, there has been a lot of evolution. Direct has come in, all those have come in. But on overall portfolios, where you can aggregate different portfolios, manufacturers, evaluate it, and all that, there is still a long way to go. Okay. Now, I also believe that in our business, because it's about money and it's about empathy, right? Because you have to empathize, and then I believe that tech beyond a certain point will not help. I think hybrid models are the need. Because suppose I invest in direct and I invest in mutual, somebody has to tell me that there is a better product now. And how will that somebody tell me unless there's a duplicate of me as a robo who can read my mind with AI and say this is the evolving product in a neobank or a consumer tech or a MLD, which I don't think is. So I think hybrid models will do with platforms of execution. And it's important that we recognize that in the technological evolution. So I think it's a combination of the two, and therefore I wanted to talk on tech. Platforms for execution have to evolve.
Very nice. Yeah.
But empathy cannot yet, may take another 5 years, I guess. But empathy, how to evolve, is something that I fail to recognize.
Very interesting. I mean, if I can understand what you're saying, between execution and empathy, you can have better and better execution because of tech. But right now, empathy has probably not been substituted by tech. You still need a hybrid model.
Yeah, empathy, risk, what does the customer want, all those things. But for retail customers,
it's the other way around, yeah.
It really helps, because for them, it is about a few asset categories, mainly mutual fund. Maybe it will help. But if they want to maximize returns, they want, like I did highlight, that over 10 years, a PMS or AIF would have may possibly give 6% more alpha year on year, which means 60% more absolute return. So a direct investor or mutual fund should be shown options on PMS, which are interesting and which I doubt a platform can give.
In fact, one of the things when we're talking about innovation, and innovation is probably not just in terms of the product. Rather, product does not mean necessarily that it is just innovation or something which you invest in. One of the things which I got as questions, as sort of feelers, is that if you could discuss from a product point of view, innovations in pricing. Do you think there are innovations there in terms of product pricing? Should there be innovations? What is your view?
No, I am a very firm believer, and I do not know your audience here, but I think good advice which gives you alpha deserves a premium. Okay, a good heart surgeon, I think you will pay the world to get the best heart surgeon around, or the best. So as long as I am giving customer alpha, I don't think an advisor or an RM should be frightened to get his price out, whether it's inbuilt in the commission or not. But it really depends on the level of ability of the customer to do it on his own. So a lot of family offices have their own fund managers to run portfolios, to build portfolios, etc. And obviously in such cases, pricing has to be lower because the capabilities are built in. So where capabilities are there, then I think pricing will be customized. So you'll have share classes, you'll have related to quantum, you'll have negotiations on fund management fee. That's fine. But where we are building value and that value remains, I think we should confidently get a price, whether it's inbuilt in the product, through commissions, etc., or through advisory fees. So innovations in pricing are possible. I mean, and it is done in every aspect of the business, but it's linked to capability of the investor.
It's very interesting. It reminds me of two statements before I give it to Kashyap. One is a popular Hindi ad which used to say, "अच्छी चीज और सस्ती चीज में फर्क होता है."
Yeah.
Yeah. And the second one is, which one customer told me when I was talking to him. And this is very interesting. He mentioned that the price remains the same. It is the ability of the customer to see whether it is a cost or whether it is value to him, which is what I think you just alluded to that when you talked about premium and making.
Yeah, but
Beautiful.
see,
Beautiful.
there is this misconception that, again, unless there are a family of fund managers, family offices having built-in people who are specialized in that area, by and large, you can't just do a direct and maximize your return. You will make decent returns. There's no question of that in passive funds or in conventional portfolios which are done through direct. But the alpha that you generate is significant.
Yes.
And when you look at it on a CAGR compounding basis, even a 3% alpha year on year is a significant jump over 10 years. And what is wealth management for? Finally, you want to be richer than your neighbor or your peer, in line with your needs, in line with your risk profile. Let's assume that most investors are in the balance to aggressive to growth framework, right? Then it is about creating wealth, right? The stage where you want to protect your wealth, you made lots of money, then I would say that putting it in low cost debt funds and all that is fair. But when you want to grow, you need to look for the best alternatives, right?
Correct. Kashyap? Can you hear me, Kashyap?
Yeah, I can hear. Thanks, Vikas. Nitin, from pricing, coming back again to the products, we have seen PMS and AIF have, worked heavily to customize, certain aspects of the investment products versus, let's say, a mass or commodity product like a mutual fund. But how else can we, sort of work to customize the products for investors? And, within that customization or innovation, how should customers also look at some of the modern, innovative products like structured products or offshore, or global investments? You also mentioned about some of the millennials looking at even private equity for that matter, even in India. So one, how do you customize the products for them? And from the investor's point of view, how do you look at these modern innovative products, which are now being made available in the market?
No. So the way to look at it is, if you look at India today, if you see the index, you made 17% return on a 5-year basis on your CAGR. If you see large cap funds, you made 20%, and the mid caps and small caps, possibly on a last year basis, you made significantly higher returns, right? So from here on, if you have to make good returns into the future, will you pick up stocks to give? Now, obviously, in equity, you're in equity to make 15% return minimum year on year. And the way I look at it, the aggressive smart investors in equity related products should target 30 to 35% returns on a CAGR basis year on year. And from here, where the markets in India are in the overvalued zone and all know about it, where I was telling somebody that right now it is a huge evolution phase in the market where water is finding its level. So to that extent, till the SIP money, the Indian saving money comes into equities, the markets will keep adjusting to a certain level, after which from there on, it will look for value in whichever way. Then your customization has to be over a 3-5 year time frame, what products to have, which will give you exposures. And if you broadly, for example, look at themes that are coming out now, electric vehicles or alternate energy or fintechs, which will evolve. And if you think that India has a runway of 10 years, like how the international investors taking exposure to India think, then your customization, since your question was around the equity space, part of your portfolios should have companies which will be your Zomato. It will give you the uptick which a Zomato gave of 135 rupees from a low investment level of $20 or $25 for an investor, or the Nikas of the world And so then your customizations should be into maybe late stage investing in kind of pre-IPO products. I'm talking again equity, or value picks in PMSs and AIFs which carry these themes going forward. There are various themes that come up: emerging India, whatever, emerging small caps, good themes. If the those ideas are taken properly, or like I gave you an example of consumer tech, that could play out in the future, or warehousing based equity. Of course, also as the Indian valuations go up, and as more and more Indians are becoming global. Okay, one of the things that we are launching in wealth, we're launching now. Our wealth management proposition is designed for the global Indian, because many of us have family and children who are abroad.
Yeah.
So I was discussing with my son. I keep trying to train him into Indian stock markets, but he talks to me about Tesla, or he says, "Let's discuss Uber." So if we don't offer him a portfolio, because he's an Indian. If I don't offer him Uber in his portfolio, I mean, what to do? So therefore, these fund of funds which take exposure into international stocks, or through the LRS route, you invest into international funds with various themes, are things which will definitely come up, and that will be the next stage of evolution. And also, I think it then today you can evolve. So our recommendation said China, US is where we are positive. So you should do some exposure there. So to that extent, that phase will evolve. On the equity side, also there are structured products we had discussed some time back, where you can build structures around equities. We have not yet gone too much into single stock structures. We are still at the broad level on structures on the Nifty. So those things will also evolve as a thought process. So evolution is over the ideas which will want to give you 30-35% IRR across the emerging sectors over the longer term, and how you get that exposure. This is on the equity side. Since your question was not related to debt, I'll stick to just equities.
In fact, Kashyap, if I can just interject here, you may not have realized, but we've already crossed an hour. The discussion has been so interesting. So if it's okay with you, Kashyap and Nitin, should I move to some audience questions? Because incidentally, some of the audience questions which are coming in are quite a few of the questions which I have on my plate as well.
No problem, man.
Yeah. This is a very dramatically framed question, but the answer probably could be very simple. Do you think exotic products are weapons of mass destruction, and one should stick to conventional asset classes? This is a question from Nimish.
No, finally, let's look at it differently. If you are setting up a business, are you not taking risk to set up the business and then make returns on the business and become rich? Did Infosys not do that, and did the promoters not make money? Did various other promoters in India not become rich that way, or globally? So taking risk and becoming rich is one of the ways of life. Now, depends on which stage you are in. That's very important. Profile is important. All that is important. But a certain portion of your portfolio has to have an exposure to alternate businesses. I don't look at exotic investing in stocks. Let's restrict to stocks. As exposure to stocks, I look at it as exposure to businesses. If I am a HNI or UHNI, or I invest in a small cap fund, which I was reading, the logic is I'm exposing myself to businesses which will hopefully become large cap long term. Right?
Correct.
And for that, I mean, and there is a basic fundamental rule of finance that small caps will give you the most return. Ventures and may not be yet in India because it's a volatile emerging market. But if it plays out the way but in US it is, why is there such a large difference between the richest investors and the next rung globally? Because they have taken risk, and one is not saying take risk for 100% of the portfolio. Let's be clear. One is saying that for 10, 15, whatever you're comfortable with. So if I want to invest for my son, I will give him risk portfolio. It could go kaput, or it could give him 5x returns in 2 years. So it is all dependent.
Relative,
So I don't look at you should empathize with the investor, figure out what is good. See, what we have seen in the last 1 year is an aberration driven by liquidity and driven by water finding its own level with new savings coming into equity markets. It can go on for 1 more year because God knows how long. Because sometimes the equity investor believes that real estate is where money is going to be made. All of them will start putting into real estate and the markets will collapse.
Correct.
So figuring out where the right level is important.
Correct.
But identifying the right sectors and taking risk is fine. Why is a Tata is investing into big basket, or why is Tata Power investing into renewable energy in such a big way? Because those are, or green hydrogen. I mean, that's because that's where the businessmen think they will make money. If big businessmen think they'll make money, why should small businessmen who have wealth not think that they should not participate in that same opportunity?
No, I think it's a very good point. Basically, you are underscoring the importance of a growth mindset. And in a country like ours, it's very important. In fact, Nimish, I'd also like to mention to you, if you would have noticed the grid which Nitin had shown in terms of product suitability and all of that. I was talking to Nitin and he said that, for example, if to a conservative investor an aggressive product gets sold, by choice of the investor, it is asked to the investor whether he's aware of the risk, whether he's aware of the whatever he's getting into. And if he says yes, by all means, he'll get into it. So I think investors are also evolving. And maybe it's the undercurrent of a bullish market, but one should stop thinking about product innovations as weapons of mass destruction, and they could be actually looked at as as alternatives to create significant amount of wealth to capitalize on what's happening in the country. So,
because I also want to add to this.
Yeah.
Finally, there can be a lot of investors who have minted money in this run and their asset allocations have gone overweight equity. That part, I mean, and if you feel that isse zyada kyun chahiye, a lot of investors say that we made so much money or whatever, we don't have that greed anymore, or you want to be cautious, then of course you have to reduce your equity exposure, and you can choose to be in AAA products which will give you 4.5% return. It will be a negative real rate of return, or you can have some exposures to fintechs which are well funded. So there are a whole host of options. No one is saying that go into exotic products or go into. All one is saying is, like how Vikas rightly said, profile, conservative, fitment of the product scale, and then a portfolio which balances all that. So do not go into it. The way I look at it, I want to be a businessman, though I can't build my own Nykaa. Not now. Maybe I want to build a renewable energy company, though I don't have the wherewithal to build it. So if there's a company which gives that opportunity in AIF or a PMS, or a small cap company which Vikas picks up in his PMS, why should one not try that? But that will be for maybe 10% of the portfolio, 15% of the portfolio. The balanced portfolio will be a conservative portfolio.
In fact, again, you have preempted a question. There was one question which Renuka has asked in terms of how do you manage customer emotion during volatility. I think unless you want to amplify some part of what you said, I think you pretty much answered that.
Yeah, it's very, very difficult question. But, but lot of investors in the UHNI space, I must say, are very cautious. Okay. They are very disciplined, and what I've been telling is actually what I've seen UHNIs do in these markets. They are booking profits, reducing their risk, taking exposure to long-term kind of solutions, and also getting into, of course, you can reduce equity risk and take venture debt risk. The risk level changes drastically.
Yes.
But it's still risk. So I think it's not that you have to chase risk all the time. You have to realize what your appetite is, and then book profits whenever it is going. So it's really about managing your emotion. And like I said, wealth manager has to read your emotion and he has to caution customers. So there are a lot of investors who book profits in this rally and then shift to debt. Why do you think there's a booming debt market in the MLD space?
Interesting.
In AA, that is also risk, but is much lower risk than equity risk. and the downside is protected, and you make so a lot of people say long-term equity returns will now be 10%. That
So might
investor
as
thinking,
well
I get
invest
that
into
in
it.
AA rated debt or single A
Might as
rated
well do
debt
it. Yes.
at 10%.
Excellent point. Excellent point.
So emotions should be managed, and it really depends on what the customer believes and what you and he agree.
I'll just take this last question, which is coming from Ashish Gulati. He's asking, how will the strategy change in wealth product offerings if markets correct by 10-15%? Or in the case when markets continue to grow like this, is there a change in wealth product offerings which will go to the customer?
See, if the markets dip, first of all, we generally talk in this business on long term. Okay, I don't, and again to explain fundamentals in investing, you invest from one cycle to the other because by nature, economies grow continuously at say 8% a year, and hence valuations keep going. And while at times they may go over the mean, in time, if the economies keep growing, the valuations keep growing. So, basic thing is markets will always go up, right? The return expectations may change, and if a country collapses, anything can happen. And
Anything can
for that,
happen, yeah.
diversification and all that is factored into portfolios, taking money abroad, etc.
Correct.
So, in situations like if the markets come down, we keep telling people that we keep looking at your asset allocation and keep booking profits so that you have money to kind of average out when the markets fall or you invest on dips. So all our current investment strategies are saying buy on dips. Okay. But if you are a guy who is not yet there in terms of growth and aggression, then there is no harm in participating in the markets, because you may want to believe that if the new normal is much higher, you want to participate. Like Mr. Junwala was bullish on the market for a very, very long period of time. So if you see strategies, he's a UHNW investor, he's built an airline company and all those things. So he believes there are certain sectors which will grow long term. So if the markets come down, of course, money, and again, equity investors are those who are committed for a long period of time.
Yeah.
So you can't get frightened of a fall in market. Market falling by 20% is fine, because in the rebound it will go up. So if you see the markets after the crisis in small cap crash more than 60-70%, 50-60%, it's all gone beyond that. So there's no problem. And so to that extent, even if it crashes as you buy up, you should have the confidence to wait, and finally the long-term game of equities plays out. A word of caution, you should know when enough is enough for you.
True.
Okay, that is very important, because you can never predict, in my view, when to exit the market. But like, this is my own personal life. I decided that at 50 years, my retirement money for me and my kids should be taken out of the markets. Right? Then it doesn't really matter what happens to the market, whether it goes up. That much money you take out. Similarly, if asset allocation is your style, then follow that style. So when enough is enough, or when you have a need, create that need and take that much money out of the market. That's also very important. Exit is also important. Entry is not just and have 5-10 year horizons. If the horizons are smaller, then you need to go more to debt and such products.
We've got some comments coming in from Rahul Chadda and a couple of other people. In fact, Girish just asked a question. Girish, I'm just going to read your question. You may not be able to answer the question due to paucity of time. His question is there a simple offering either as PMS or AIF where customer can take exposure to equities, debt and gold so that we rotate asset allocation? I think maybe this is a question which you can write in directly to Nitin. But my sense is if you're looking at a multi-asset allocation sort of a strategy, it is best done on a mutual fund platform, and there are quite a few there. The more sophisticated an asset class, the more concentrated it gets in terms of that asset class. But thank you so much for your questions, ladies and gentlemen. I think you've always been a very loyal audience. You've always logged in, and we hope that you enjoyed the discussion. I personally made a lot of notes while I was writing here, and I think the undercurrent throughout, I heard this word at least 8 or 10 times coming in from Nitin, and it couldn't be emphasized more, is the word empathy. Okay, so Shivendra, you're talking about ESG rated funds. I think Nitin, now the questions are coming in thick and fast, but probably it's time. And if it's okay with you, Nitin, I think we'll give
I'm
Ashish
happy.
Gulati.
I don't have a problem. See, also, I think everybody today understands the market. And as long as they empathize, we can always answer these questions. Really, it's really not a problem.
Sure. So I think thank you, Satyam, for your comment. He's saying it's very informative. Thank you for the amazing talk. And if it's okay with you, I think Ashish Gulati, who asked that question about asset allocation in up and down markets, should we just give him the question for the price for the best
no
question?
problem.
Yeah.
You're the boss.
you were, Nitin, as always, you're a very this is a very humble, nice gesture of yours. I personally made a lot of notes. I'm telling you that, and I'm going to shamelessly use that in some of the pitches which I'm going to make. I'm not going to give you credit. I'm going to use them. There's some
problem.
amazing insights which you've given. Thank you so much, Nitin. Sankalpo, over to you.
So thank you, ladies and gentlemen, for being so patient on a Friday evening, and I hope you enjoy the India-Pakistan match over the weekend. With that note, thank you, Nitin. Thank you for being with us and patiently answering so many questions. Unfortunately, a lot of audience questions remain unanswered. I'm leaving my email ID on the chat. You can put them across to us, and then we can get them answered for you. But thank you to the audience. Thank you, Vikas. Thank you, Kashyap. It was great having you here.
Thank
Hope
you.
again soon. Nitin, thank you from the team at PMSAIF World and Incred. We extend our heartiest greetings to you. All the best for the festive season ahead. To the audience, hope to see you real soon. Thank you.
Thank you very much.
Thank
Thank
you.
you.
Thank you. Bye.
Bye.